You know that absolute worst feeling in trading? Like setting a stop loss, getting bumped out by some tiny random dip, and then just watching the stock immediately rocket to the moon without you.
Oh,
I mean, it is the ultimate emotional trap.
oh, it really is. And well, it usually happens because traders are just completely obsessing over price direction, right? While basically ignoring the underlying turbulence of the asset itself.
Yeah, exactly. Which is why today we're looking at a metric that acts as a sort of mathematical shield against that emotion, the average true range, or ATR. And welcome to everything you need to know about finance. Oh, quick housekeeping for you. This is strictly a deep dive into the concept, so not financial advice for your portfolio. But hey, if you find this kind of content interesting, please like and subscribe.
Right, and the wild thing about ATR is that, it isn't some shiny new algorithm. J. Wells Wilder Jr. actually introduced it way back in 1978 in his book, New Concepts in Technical Trading
Wait,
Systems.
1978.
Yeah, 1978. But yeah, nearly 50 years later, it is still the core engine behind modern volatility tracking. It's incredibly up to date for modern charting.
So if Wilder wanted to measure pure volatility, he couldn't just look at standard daily highs and lows, right? Because, like, if a stock closes at $50, then terrible news breaks overnight, and it opens the next morning at $40, the standard daily range completely misses that massive overnight gap. So how did he actually quantify that?
Well, that was his genius. He created the true range. Instead of just looking at today's high and low, the true range actually factors in yesterday's closing price.
Oh, so it captures the full magnitude of the swing, like overnight gaps included.
Exactly. And then to get the average part of the ATR, you usually just run a 14-day exponential moving average on those true ranges.
Right, so you smooth the data out. That way, one freak news day doesn't, permanently warp your risk model for the next month. It's almost like a ship's radar for ocean swells. It doesn't tell you if you are sailing north or south, only how big the waves are around you. Which brings up an obvious question. If this doesn't tell us which way the price is going, why do traders actually care?
Because if you don't know the size of the waves, your ship is going to capsize. This is the absolute core of risk management, specifically for an application called a chandelier exit.
Okay, yeah, I've seen this in practice. So let's say I buy a stock at $50 and its current ATR is $2. Instead of just randomly guessing a stop loss based on, well, what I'm emotionally willing to lose, I let the market's current rhythm decide.
Precisely. So you might set a 2 ATR stop.
Right, so $2 times 2 is $4. I subtract that from my $50 entry, and my stop loss sits mathematically at exactly $46.
Perfectly executed. And the psychological benefit there is just massive because you aren't getting shaken out by normal market noise.
Yeah, you've given the stock the exact amount of room it needs to breathe based on its recent behavior.
Right. So if it hits $46, you know the trend is actually breaking, not just having a little hiccup. And it also dictates position sizing. Like if the ATR is sky high, meaning volatility is wild, you trade a smaller position.
Just to keep your portfolio risk flat.
Exactly. Plus, if you see that ATR suddenly spike, it's a huge signal that momentum is shifting, which usually means a breakout or a reversal.
And the beauty of modern charting is that, thank goodness, we don't have to calculate this by hand. Any broker app or a site like FinViz handles it instantly. Usually it defaults to 14 periods, but you can dial it down to 7 if you want a faster, more sensitive read. But here's where I'm going to push back a little.
Okay, let's hear it.
Once you turn on the ATR indicator, you inevitably stumble upon its sibling, which is the ATRP, or average true range percent. Wait, if I already have the exact dollar amount of the swing, why overcomplicate it with percentages? Like, if my ATR is $10, I know my swing is $10. Seems like absolute overkill to run another formula.
Well, it seems that way, but dollar amounts in a vacuum lack vital context. Think about it. A $10 daily swing on a $500 stock is just a gentle breeze. It's just a 2% move.
Oh, right, but a $10 swing on a $40 stock is an absolute hurricane.
Precisely. That is why we need to standardize the volatility. ATRP converts that raw dollar value into a percentage of the asset's current price.
Ah, I see. So if you're scanning the market and say stock A has a 5% ATRP while stock B is sitting at 1%, you instantly know which one is the wilder ride relative to its price.
Yes, it makes comparing completely different assets instant and just crystal clear.
Okay, that makes perfect sense. It standardizes the chaos. So what does this all mean for you listening at home? It means volatility isn't just some unpredictable force of nature. It is a measurable, manageable tool.
Right. By mastering indicators like ATR and ATRP, you can navigate the future of any stock you trade with far more confidence. You aren't just guessing, you are mathematically preparing yourself for the exact size of the swings ahead.
Which leaves you with something to think about. Go look up the ATRP of your favorite asset right now. Is the ride bumpier than you thought? Thanks for joining us on this deep dive, and be sure to try out our latest episodes.